Ken Shinoda joining us now, portfolio manager over at DoubleLine Capital. And Ken, as he was asked that question about financial conditions, you heard it at the end. He said that there are two key criteria that he's looking for to assess that, whether those conditions are persistent and whether longer-term rates are moving up in a way that is actually a reflection of expected policy moves. Are we meeting those conditions?
Well, rates have made a big move higher. I think that has restricted financial conditions, and it's one of the reasons that they chose to pause today. It was kind of a unexciting meeting. I think the market had already expected that there would be no move today. A lot of Fed governors had telegraphed that going into the meeting. I think the bigger news was the Treasury refunding this morning. You know, one of the things that had driven rates higher, although some people may not agree with me, was the Treasury supply. There's just been massive Treasury issuance, which has been a lot on the
Janet Yellen disagrees with you, Ken.
That's okay. She can disagree. But this morning they came out and they said they're moving more, less bond supply to the long end, more to the front end. And I think that really sparked the rally. And we had kind of a hat trick of positive news for the bond market. It's been months without positive news. Started off with the worse than expected ADP report. Then we got the Treasury refunding. And then lastly, manufacturing PMI coming in lower than expected, 46, showing signs that the economy continues to weaken in certain parts of it.
Yeah, you look at the 10-year yield intraday chart, and it's clear it took a leg lower right about 8:30 a.m., another leg lower at 10 a.m. when the ISM numbers came out, and then once again during Powell's news conference. I want to go back to that Treasury refunding announcement for a moment here, because Treasury increased the issuance in the 2 to 7 year sector, but slowed the increase in the 10 to 30 year sector. Is this evidence that rising term premiums is driving some of the or all of the decision making there?
I think it's a mix of factors. You can't just say it's term premium. I mean, many things that pushed bond yields higher. It was better than expected news from economic data. It was the higher for longer mantra. Don't forget Japan coming off yield curve control. So it's kind of a perfect storm, I think, that has helped the long end move up and kind of doing some of the Fed's job for it. And that's why they've decided to stay on hold here.
And Ken, outside of just the Treasury market, I want to talk about this from a portfolio perspective, because one of the notes that you sent over that caught my eye, you write that agency MBS is one of the most unloved assets this year, which is very sad. But Ken, do you love agency MBS at this juncture?
You know, it's everything is tighter this year. Almost everything is tighter here in the spread universe. Many credit markets have done very well. High yield, bank loans, investment grade corporate bonds. Yes, they've widened a little bit, but agency mortgage spreads have been widening all year. Similar to the Treasury market, thanks to bad supply-demand dynamics. A lot of the buyers are out of the market. The Fed is not buying. The banks are not buying because the deposits are leaving. Money managers are sitting on the sidelines as would-be buyers of bond funds sit in T-bill and chill. And so you've seen spreads widen with the sale of Silicon Valley Bank's assets from the FDIC. That's almost done now. Rate volatility sure doesn't help mortgage spreads either. But just to give you an idea how cheap they are, they're almost 100th percentile relative to their own spread history going back 10 years. And relative to corporate bonds, they're almost 100th percentile going back 10 years. They've underperformed the corporate bond index by about 190 basis points annualized for the last 5 years. And it's not surprising. We manipulated their prices during quantitative easing, and now we're coming out of that. And so they're suffering. But I definitely think it's a very interesting entry point for those looking for some high quality assets. And they're not that long. A lot of people don't like 10, 30-year treasuries. Mortgages sit more at the belly of the curve, which may be more palatable for people seeking more shorter bond profiles.
Well, that's what I'm curious about, Ken. The fear of going down that route with MBS is the idea that it's the duration risk, the reinvestment risk that are scaring people away right now. I mean, when I think about 5 years or even going out as much as 10 years, that doesn't seem long duration at this stage.
I think some of it is a lack of understanding of the risks of mortgage-backed securities, which revolve more around prepayments than they do credit risk when you buy corporate bonds. But the prepayment risk for many mortgage-backed securities is extremely low because so many people locked in 3.5%, 4% mortgages. The mortgage rates could fall 200, 300, 400 basis points even, and many of these borrowers can't refinance. Now, new bonds being made today with 8% mortgages are obviously carry a lot of prepayment risk in case rates fall, but there's many places to pick and choose your investment opportunities within the universe.
All right, Ken, always wonderful to catch up with you.